Good morning, everyone, and welcome to this webinar. Thanks for joining us today. We have lots and lots of people coming in and joining us from all over the province and probably some from even slightly further afield. So it's great to have you here. We would like to start. We have someone great on the back end supporting us on these webinars. Her name's Linda, and she really comes up with great creative things. So today we're going to do a poll just while everyone settles in and joins us. And we're going to ask you if you could pay yourself in something other than money for a month, what would it be? And that can be it could be coffee, it could be travel points, it could be chocolate. I'm eager to find out what that was. So eager to put those answers in. And while you do that, I'd like to introduce myself. I'm Matt Hill, Director of Operations and Client Service here at BusinessLink. And really, we are here to help you start your business, to grow your business, and to support you succeed. We do this through a variety of ways, one-to-one meetings with clients. We have a 1-800 number. So if you've got a quick business question, we can answer that. We're happy to sit down for meetings with you. And we're very happy to run education programming like this. I would like to start with our land acknowledgement and say that BusinessLink acknowledges and respects that we're on traditional land, meeting grounds, territories, and territories, gathering places, and traveling routes of Treaty 4, 6, 7, 8, and 10, and the home to many First Nations, Métis, and Inuit people. In the spirit of reconciliation, we acknowledge the lands of those who have come before us, reside here now, and in the future. So, like I say, thank you, and thank you everyone for contributing to that poll and adding their answers there. Today, we're looking at salary versus dividends, how to pay yourself as a business owner, and I'm very happy to be joined by Vartika Satija, a accounting and tax professional. So, Vartika, if you'd like to turn your camera on and join us, that's awesome. Hi, Vartika.
Hey.
Hey, excellent. And so just a little bit of housekeeping before I kind of hand over to Vartika here. If you've got questions, I'll be monitoring the chat, and there's also the question and answer tab there. You won't see all the chat that kind of goes on there, but I'll be watching those, and I'll ask those questions or some of those questions to Vartika as we proceed here. And so that's something to watch out. And then we always have this question: will I get the recording afterwards? And so yes, you'll receive an email with a link to this recording, and it will be on YouTube accessible afterwards as well, so you can definitely catch up with things there. But then that's my work is done really here, and now I'm heading over to Vartika and saying for this session I'd like to welcome her. Vartika's independent chartered professional accountant and founder of her own accountancy and tax practice. She works with sole proprietors, incorporated businesses, and nonprofits, providing tailored financial insights, tax advisory, and compliance services. She's got extensive experience in personal and corporate tax planning, and she helps businesses optimize cash flow, achieve financial growth, and stay tax compliant. Her consultative approach ensures clients receive practical, strategic solutions for their unique financial challenges. So thank you very much for giving your time and sharing your knowledge with us today, Vartika. Yeah, over to you.
Thank you, Matt. Thank you very much for that introduction. And I am really excited to be here today presenting on this I would say, popular topic on how to pay yourself as a business owner. So this is definitely, everybody's question. And I get this question all the time when you have an incorporated business. So thank you everyone for taking this morning to attend this session. And I really hope you walk away with some valuable information today and, make those wise decisions for your own businesses as well. So as Matt said, I'm an independent, accounting. I run my own independent accounting and tax practice here in Calgary, Alberta. I do a lot of tax compliance, tax advisory work for small to medium sized business. So let's take on this presentation, all this awaited topic that we all waiting on to find out what's the best way to pay yourself as a business owner. So hoping the slides work for me. There you go. It does. How should you pay yourself, basically? What's the best option for an owner managed to distribute excess profit earned in the corporation. So when we talk about excess profit, we talk about your gross income. So all the revenues from, all the revenues from the consulting services or sale of products that you make, and then you reduce all your expenses, so your operating expenses, then you come up with net income. And net income, of course, you got to pay your taxes. You cannot, run away from paying taxes. So then you have your taxes to be paid, and then you have this excess profit that's staying in the corporation. And now you as a business owner want to extract that money out from the corporation. And what's the best way to do that? So you have two options. I would say even more like three options. So either you as a business owner can set yourself up on a salary plan, or you can take a one-time management bonus, or you can basically pay yourself as a dividend. Now, there's some business owners who come and tell me, can I actually work as a contractor for my own corporation? And I say that term doesn't match up to me. When you're a business owner, you're a business owner who basically is your own business, and you can probably go on a payroll. We'll talk about some advantages of being on the payroll for your company and get it as a salary, or you can take dividends because you're a shareholder. You have percentage ownership in your corporation. So I'm not like, I'm not a big fan of like, setting yourself up as a contractor for your own corporation. Now, the answer is it always depends. It's never like one better than the other. So the answer will always be it depends. So we'll talk a little bit about the differences between, what it means to take a salary. So as I mentioned, salary involves compensating the owner with a fixed and regular payment in return for the work and services they do within the corporation. So it's like, you having a third, like an arm's length employee. Similarly, you can set yourself on that fixed and regular payment, whether we do a bi-weekly, we do a weekly, we do a monthly, we do a quarterly. So you can actually set yourself on that regular payment from the corporation. Again, it's in return for the works and services you're doing for the corporation. And you'll probably have that agreed upon in advance. So it's not something I decide 6 months down the road, oh, by the way, I want to go back to January and take myself a salary for January. Again, we do some planning around it if you want to consider yourself like a one-time management bonus, but definitely not like as a regular, fixed salary that you do. It has to be done. It has to be agreed upon in an advance, payment form. Again, you have the flexibility whether you want to be on a monthly, bi-weekly, or a weekly amount. On the other hand, you can actually compensate yourself as a dividend. So dividend basically is the distribution of company's profit to the business owners. And when we say business owners, you want to make sure you are considered to be a shareholder in the corporation. So you have a percentage ownership in your corporation to be able to, extract money as a dividend. Now, dividend is a very flexible option. You can decide 5 months down the road, hey, by the way, I want to take out $5,000 from my corporation. Or 6 months down the road, you decide to take $10,000 from a corporation. There's no payment compliance. It's just simple and easy that you take the money out personally from the corporation. So it's a much more of a flexible option compared to a salary. So just a bit of a little bit of a difference between, how salaries and dividend works from the corporate side of things. So salary or a management bonus that is paid out to the business owner is always going to be considered as a deductible expense. When we say it's a deductible expense, which means it actually lowers the corporation's taxable income. So, how I talked about revenues minus operating expenses, and then salary can be one of your operating expense, and then it actually reduces your taxable income, the net income tax that you're going to be taxed at in the corporation. On the other side, dividends are issued and paid based on the share percentage ownership. So no, dividends are not going to be seen as one of your operating expenses. It's basically after you've paid your operating expenses, you've paid off your taxes, then you're left with after-tax profits. you've paid you've paid your taxes, after tax profits, and that's when you issue or you pay out the dividends to the shareholders. I will come back to this point later on in my slides. The reason I'm bringing this up is because one matters in terms of how it reduces the corporation's taxable income. The other matters that it does not reduce the corporation's taxable income. So you will probably see a little bit of a change in the tax rate in the corporation side of things. We will go more into the details, and I will be looking at an example as well. But for now, I just wanted to bring this difference up. Again, as I've mentioned already, salaries paid out before corporate profits. So before actually, you're paying out the taxes, dividends are paid out after tax corporate profits. With the salary, your corporation is supposed to issue a T4 slip. Just like, you working anywhere else and being on a payroll, similarly, you as a business owner will also be on your corporation's payroll, and there should be a T4 slip that has to be issued. The deadline for the prior calendar year is always the February 28th. Similarly, dividends, you still, even though it's a flexible option, the corporation still has to issue a T5 slip. So this T5 slip, issuance is basically the confirmation to CRA that there was dividends that was taken out from the corporation. And then now this T5 slips makes it obligatory for that individual shareholder to report it on their personal taxes. So that's basically why you have to issue these slips. We cannot just, not have these slips issued from the corporation. And they're both due on February 28. So keep that deadline in mind. Let's look at some benefits of receiving a salary. Again, I mentioned that you will be getting a T4 slip. We've talked about this. Salaries paid is an expense for your corporation, so it actually lowers your taxable income. So you can keep it below the 500,000. So when we talk about small businesses, we talk about your net income as 500,000, not the gross income. Your gross can be over 500, but when we reduce with all the revenues, we talk about 500,000, which brings it down to a small business level. And again, I'll talk more about what's the advantages of being that, because then you get a small business tax rate. It helps you reduce the taxable payable in the corporation. So salaries will help you do that. Salaries help you build an RRSP contribution room. Again, this is a very important retirement consideration for a lot of people. So if you want to build that room, you know how every year we can only contribute into RRSP if we have a certain contribution room, the limit. And that's what RRSPs help you build that room for year over year. It also helps you contribute into Canada Pension Plan. So, and based on how long you have contributed, it could be a very important retirement consideration for a lot of people. So salaries actually help you do that. Now, I also just want to add on a little bit about the CPP. So people think that, CPP is only available when, let's say I retire after 65 and I can start claiming CPP. But, people don't realize that there are other benefits like CPP disability benefits. Let's say you stop working and you're not able to work for any kind of a disability, you may be able to qualify for CPP disability benefit. So you don't really have to wait. It's not only something you get after the age of 65. And then another thing is CPP survivors benefit. So let's say something was to happen to you, and then you have a common law partner, a spouse, they do get some kind of a survivor benefit on your passing. Again, that's only available if you have contributed into CPP. So if you have never contributed into CPP, by taking the salary, then that you won't qualify for those options. So always keep that in mind. So CPP is not just for, retirement pension. It's also for other benefits that you can qualify through CPP. With salary, here I always think it's an advantage, because I know some people like, oh, I pay so much taxes on a monthly basis. I think for a business owner, it's great that you are remitting the taxes on a monthly basis so that, your taxes, like your personal taxes would be paid off when personal tax season comes around. So it's not like that one big surprising bill. So if you have been taking 100,000, money out from the corporation, and then you have this big tax bill at the end of the year, that's a big surprise. So having to be on a salary plan and making sure that you're remitting your monthly taxes and your CPP, I think it's actually an advantage when you're on this, and it's nice just to be able to have it paid on a monthly basis rather than or a quarterly basis rather than having to pay that one big bill. All right, so some more benefits. This is something I hear a lot. Like, if you are applying for mortgages, banks like to see that steady and predictable income. And if you have provided a T4 from your corporation, I find there's never no questions asked, or it's just a very smoother, easier way for you to qualify for mortgages. Whereas, like, if you're on a dividend plan and you're providing a T5, there's a lot of more questions. There's more scrutiny, more questions, things like that happens. So something to keep in mind if you are planning to apply for mortgage in the future, you may want to consider being on a salary plan, just for the simplicity of it. Now, not to say that being on dividends doesn't qualify you for a mortgage. It does. So don't take it as like, oh, I have to be on a salary. But I just say that, just to keep things simple, easier, and it's not questionable because banks are very familiar about T4 slips. That's basically it. Childcare expenses. This is very important. On our personal taxes, we can actually claim childcare expenses. So if you're paying, any kind of money for your child to a daycare or to a nursery or to a nanny or anything of that sort, you can claim that as an expense as a deduction on your personal taxes. However, you have to have a salary income to be able to claim it. It's one of the very key items to remember that if you have children, you definitely want to consider yourself being on a salary, because if you have dividend income, you cannot deduct childcare expenses. Something to be mindful of. And then salary income also makes you eligible for some tax credits on your personal side, like CPP tax credit, refundable, federal non-refundable tax credits, like the employment non-refundable tax credit on your personal tax returns. So something to be mindful as well that, when we do the personal taxes, we can qualify for some of these credits too. I just put this slide in here, not that everybody actually has this individual pension plan, IPP, but I have noticed some banks have started to promote this product, IPP, to business owners, where the business owners can actually use the corporation as a vehicle to save up for their pension, for their retirement, and they can contribute into something called as IPP. There's a lot of eligibility criterias, but one of the eligibility criteria is that you should be on a salary plan, as per my understanding, that, they like to see that the individual owners is actually getting a regular salary from their corporation to qualify for something like that. And then the other one also I like to bring up, which is not on my slide, are health insurance plans. So if you are planning to get health insurance through your corporations, again, always reach out to your advisor if you're the only person, whether it's beneficial to get it in the corporation versus, getting it personally, because, you want to make sure it is actually a plan for you and your employees. So if you are the only person in the corporation, we have to do that determination whether you are getting that plan as a shareholder or as an employee. But if you do determine that you are getting a plan under your corporation, then you should be on a salary plan, because again, it is under the capacity as an employee that you get a health insurance benefit. So that's not on my slide, but something we always talk about, when individuals are planning to be on a salary in the corporation. What are some of the drawbacks? We talked about all the great things. So some of the drawbacks is, of course, the CPP. So when you pay for CPP now, your corporation pays the employer portion, and so does you as an employee who pays the employee portion. Every year, the CPP rates are increasing right now, so it is a big cash outflow from the corporation. Right. So the CPP almost 10.9% is where it's going. Again, always think of this as a future savings for yourself, rather than thinking of it as a limit in cash available. However, I like to bring this point out because, sometimes when you're struggling or you're just getting things going in the corporation, you probably want to keep the cash in the corporation rather than, expending it out. Now, corporations will have to set up a payroll account. There's a bit of an administrative work that is required. You have to make timely remittances. I always recommend, individual shareholders or business owners to always set up on a payroll software. Don't even, get on being like saving the cost and saying, oh, I'm going to do it myself. I'm going to make that payment on a regular payment to the government, because if you miss a payment, the interest and penalties will outweigh the benefits of being on a salary plan. So always just make sure that you are set up on a payroll software that is taking care of it, no matter how much. I know it's a bit of a cost, but it definitely is worth the cost than doing it all by yourself. And then just be mindful. I've put this point up here about EI. So EI will not apply if you're a shareholder who owns less than 40, owns more than 40%. So if you're a shareholder who owns less than 40% in your corporation, that's the only time you need to go and remit EI. But otherwise, you don't have to remit EI because you as a business owner cannot actually apply for EI later on. Now, there are some situations where people do apply for like they can opt to, remit into EI when they want to go into maternity or paternity leaves in the future. So as a business owner, you can do that, but you have to opt for that. You have to get a permission that you want to contribute into EI so that eventually down the road you can get EI. But as a regular business owner, if you're owning more than 40%, you don't have to remit into EI. So just CPP and income taxes. But coming back to the drawbacks, you have to set up the payroll account. There is a bit of an administration, work that is required, and making timely remittances is highly, highly important. Otherwise, you may have penalties and interest and things like that with CRA. All right, let's go into the benefits of receiving a dividend, which is a T5 slip. Again, dividends are not subject to any payroll deductions like CPP EI premiums, and that's quite a savings in cash flow for the corporation. You don't even need to register for a payroll account. There is less of, the whole administration and professional fees that may incur when you're setting up for a dividend. When you're setting up for salaries, there's always additional professional fees just because of the nature of, setting it up and paying yourself a regular salary and things like that. There's no contributions into CPP, which again, for some corporations can be a significant savings. Paying a dividend can qualify you for a dividend tax credit. Again, we will look into a bit of an example later on, where you as a personal on your personal taxes, you can get that dividend tax credit. Now, this is a point I did not go much into the detail, but I'll just give you an overview. Let's say your corporation has investment income, not just active income, but investment income, and your corporation ends up paying a higher tax on those investments. But if you extract money out as a dividend, your corporation can recover some taxes on that was previously paid. So we call it RDTUH, refundable dividend tax on hand. So again, I always look at if a corporation has investments, then we may have to do a bit of a dividend as well for the business owners so they can actually recover some taxes that the corporation ended up paying on the investment income. Dividend, again, is a very, very flexible option while distributing cash anytime during the year to the shareholders. What are some drawbacks? I think this is a drawback that you cannot build that RRSP room and cannot contribute into CPP. So I think this is definitely a drawback. Like, if you're just constantly taking dividends, then you're you're not saving up for the retirement pools. And sometimes some of the great, investment pool, as we know, could be RRSPs. So something you have to keep mindful of. They don't qualify for these employment tax credits or childcare expense deductions. Something to be mindful if you have children and you have children, you're paying for childcare, you may not be able to deduct if you're taking dividends. Dividends paid to children below age 18. This is something I have always seen that, people want to bring in their children into the corporation as a shareholder and start paying them dividends for income sprinkling purposes, or splitting purposes. And we say that there's always that additional kiddie tax. So be mindful if your children are below 18 years old getting dividends from the corporation. If they're a shareholder, they might be additional tax rates on it. Tax on split income, it's called TOSI, and it applies to dividends that are paid out to individuals who are not actively engaged on a regular, continuous, or substantial basis. Something to be mindful as. All these new rules came into place in 2019 onwards when, the Trudeau government did not want people to income split between their non-active spouses or common law partners who are not actively involved in the business, but are getting dividends. Dividends do require, you need to pay quarterly tax installments. So let's say the year before you owed more than 3,000 in the corporation, like in dividends, then you will be required to pay quarterly tax installments. This is just because the government doesn't want you to wait till the end of the year to pay that one big bill. All right, so I'm just going to quickly bring up tax rates for the CCPC. When we talk about CCPC, it's Canadian Controlled Private Corporations, which I'm hoping most of us are in here. This is what I was talking about, having a small business deduction rate, which is only available to CCPCs. And there's a bit of like a criteria to follow to fall under a CCPC, that you're a Canadian control private corporation, your active businesses are in Canada or surrounding areas. Also, it's owned by Canadian residents. That's also another big criteria of being a Canadian controlled private corporation. And this slide, I just wanted to put it out there. Again, I usually do a presentation just specifically on corporate taxation, but this one I just wanted to bring out to make you understand about bringing your income down to 500,000. And 500,000 again only applies to eligible income like the active business income. And active business income is like business income from operations, your consulting revenues, from sale of any kind of products out there, any items. So that's basically the active business. Whereas up to an annual limit of 500,000 qualifies you for something called a small business deduction. So a small business deduction is only available if your net income is up to 500,000. So sometimes we do this kind of tax planning to give people a salary so we can bring your net income down to 500,000. Again, if you are a shareholder who owns multiple businesses, it has to be shared between all the corporations. So that's why I put this slide saying that it has to be shared amongst the associated groups. So it's not like, each individual business gets that 500,000. It has to be shared if you have, control rights in the corporation. And your aggregate taxable capital employed in Canada should be over 10 million for the associated group as well. So Matt, you know what? Before I move on, I feel like I'm going to stop here and take some questions because I think we've talked quite a lot right now.
It's such great information, so thank you so much, Vartika.
You're
And
welcome.
there are definite questions. Some are quite technical, and so
Okay.
people have asked questions that I may just say that is probably a conversation for their accountant, as it's maybe just
Okay.
applies to them in this context. So I'll pick some of the more general ones. So the first one, I mean, it's quite foundational, but can you just clarify, are dividends only possible if you're incorporated and not a sole proprietorship? So Kelly asks.
Yes, that's a good question. Yes, you have to be a incorporated business to be able to take that money out as a dividend.
So really, yeah, the focus of today is absolutely on if you are incorporated.
Incorporated,
Yeah,
yes.
someone else asked the question, any tax advice for a solo proprietor? And they just kind of go on, when income is really, really low and they're just starting out,
Mhm.
is this a good way to start and then later shift to a corporation, or no? Should they kind of incorporate straight away?
Yeah, so you know what? This is a very broad question and it will depend from business to business. I can only talk from a tax point
Yeah.
of view. You always have to look from a legal point of view. You know, there are certain legal obligations that a business needs to be incorporated. From a tax point of view, we always advise, yeah, you should have substantial income in the corporation. So you can leave the money in the corporation to do some tax planning and to be able to defer some taxes. So we can do that if you are incorporated, of course. But if if you're not making enough income and you need to use all that money personally, there's not much advantage from a tax point of view to do that. I have a blog on my website if people like to look at. It's called when is a good time to incorporate.
That's perfect. Yeah, it's one of our definitely our most common questions. Um, Excellent. And can you pay yourself? You kind of address this. Can you pay yourself as a contractor to avoid payroll costs?
Yeah, so I actually don't recommend that. Apparently, as a contractor, there's few reasons, okay? Few reasons is first of all, you're getting compensated for your services in the capacity as either a shareholder or an employee. That's kind of how I see it. If you're saying you want to get you paid yourself as a contractor, now a contractor needs to charge GST once you cross the $30,000 mark. Are you going to charge your corporation a GST and go and start registering for a GST account on a personal level? So I feel like it's a little messy, to be honest, in a contractor basis. I like to keep it simple, clean, and say that, hey, either I'm an employee or I'm a shareholder taking it in the capacity as a shareholder.
Thank you. Perfect. And then, kind of one final question
Sure.
which has been asked in a few various forms. So, can we do salary and dividends and a mix of both? And is
Yes, I'll talk more about that later on in my slides. So
oh,
let's just
perfect.
hold on to that question.
Exactly. As I asked it, Sarah put that exact question as well. So it's definitely
Okay.
people are eager to. Oh, and then there's one kind of practical thing. So how does a business issue a T4 or a T5 slip? Like, what's the process template for doing this, and how do we?
Yeah, so we have softwares, of course, we apply in our practices. So we actually do this kind of issuing those slips from the corporation. I'm hoping they have advisors, in-house who are doing their accounting or they're doing their year-end taxes, and we usually do it as a year-end tax package. Now, that's how we do it. And we use our softwares, and then we look at all the salaries for the year. We look at all the dividends that has been taken to the year, and then we can actually issue that slip and submit a copy to CRA as well.
Gotcha. Understood. Yeah, that's perfect. Excellent. Well, this looks
We
like
can
an
move.
exciting next chart. Let's look at the table.
Okay. Sounds good. I just ended up putting a little chart here, a little table here for people to see what if they are making under 500,000 in net income, what are the tax rates they're paying in the corporation. So if you're an Alberta-based corporation, there's that Alberta provincial tax of 2%, but federally we are paying 9%. So your corporation, if it makes under 500,000, is only paying about 11% taxes. So this is where we were talking about, it becomes beneficial to incorporate if you can leave a little bit money in the corporation so you can defer that taxes on the personal side. So you can actually leave, let's say you make about 400,000, you only took out 100,000 from the corporation. Personally, you're paying taxes only on the 100,000. Corporation pays only on the 400,000. Again, sorry, on the 300,000 because it's 400,000 minus a salary of 100,000. So then corporation pays a lower tax of 11%, and not until you as a business owner takes out that money, you pay your personal taxes.
Okay.
Again, I just wanted to make sure you're understanding that this is only on active business income, not on investment income. So active business income is just that lower taxes. Now, when you start, making money from investment incomes, like, dividend income, interest income, sale of stocks, things like that, or royalty income, then the tax rates are pretty high. Okay, so just a big overview of the types of dividends. So there's always two types of dividends that can be issued, and their tax rates are different, and their tax credits are different. And that's why I kind of brought this slide out here. So if you're a corporation that is taxed on a higher, so you're over the small business deduction, which means like, your net income is over 500,000, your corporation pays a higher tax rate. And when your corporation pays a higher tax rate, it actually accumulates something called as eligible pool. And out of that the GRIP balance, and out of the GRIP balance, we can actually pay eligible dividends, which again is much more advantageous on the personal side. So your personal tax dividend tax rates can be higher if you have eligible if you're paying out an eligible dividend. A lot of small business corporation fall under this something called as other than eligible dividends. Corporations pay lower tax on it, so which means then you get a lower dividend tax credit on the personal side. Again, I'm just very, very, very holistically bigger picture. It's something I just wanted to put it out there to show you that there's a difference between eligible versus non-eligible dividends, and the tax rates can be different on your personal versus your corporate side of things. Okay, so I'm just going to quickly bring this up. Again, the eligible dividend, sorry, other than eligible dividends, which most small businesses do fall under, or medium-sized businesses do fall under, it's probably like, as you see, we gross it up on the actual dividend amount, and you can see the federal dividend tax credit is kind of lower compared to the federal dividend tax credit that you get on an eligible dividend. So for example, you took $200 out as dividends. As an other than eligible, it's 15% that gets grossed up. Whereas eligible dividend, it gets grossed up as 38%, whereas the federal dividend tax credit you get is about 9%, whereas federal dividend tax credit you get as an eligible dividend is almost 15%. So there's that difference of these two different kinds of dividends that you're taking out from the corporation. So I'm going to look at an example. I think everybody was waiting for an example here. As you can see, we start off with corporate business income. Let's say the corporation brings in revenue of 100,000. They ended up paying themselves a salary. So you can see in the salary column, that's a deduction. So they took out 50,000 as a salary. Now the corporation also has to incur the CPP portion of the salary. So we kind of like took that 5.4% and come up with like $2,000 on a 50,000 salary. This is the corporation's CPP portion that they have to incur. Now you can see the corporate taxable income is 47,000. Whereas dividends, again, we don't take it as a deduction. So everything right now is the earnings that you made in the corporation is considered 100,000 in the corporation. Now, we apply the corporate tax because a lot of us, I'm assuming, are Alberta businesses. We pay about 11%. So the corporation ended up paying 5,000, approximately 5,000 when they took a salary plan. They ended up paying 11,000 in the corporation. Okay, so you can see with you taking a dividend, corporation ended up paying a little bit higher taxes, whereas in a salary, corporation ended up paying a lower taxes. So then you can see at the bottom, we then extracted $50,000 as a dividend because, that's always after tax money and dividends. And the retained earnings that was left in the corporation when you took a salary was 41,000, whereas you took a dividend was 39,000. So just hold on to that thought that when you're when you're taking a salary, your corporation ended up paying a lower corporate taxes, but the corporation ended up paying a higher corporate taxes by taking a dividend. Okay, so just hold on to the thought until we move on to the next slide. And then we look at the personal tax side of things, because you as a business owner, you cannot just look at only the corporate taxes. You have to also look at the personal side of things, right? So here is how the personal side of things work. As a salary, you took $50,000 of salary. Then personally, you ended up paying your, CPP portion to the government. And I actually took like an approximately 25% of taxes on the personal tax. Again, I'm just averaging it out. And you can see personal tax, income tax rate of 25 like percent that I took. The proceeds that was left after tax in the hands of the business owner was 34,000 personally. Okay. Just because they paid 50,000, this is how much they paid personally. They paid a little higher taxes. On the other side, when they took a dividend, dividends do get grossed up, 57,000. So 50,000 got grossed up to 15%. And then again, I applied the same 25% taxes, but they also are eligible for the dividend tax credit. So we applied the dividend tax credit on the personal side. So you can see they ended up like paying little less taxes on the personal side. So they were left with more money after tax, more money on the personal side. So did you understand the thought? So on the corporate side, the business ended up paying higher corporate taxes, but by taking a dividend. But on the personal side, they ended up paying less personal taxes by taking a dividend. Whereas from a salary point of view, the corporation ended up paying less corporate taxes, whereas on the personal side, they ended up paying more personal taxes, right? Because we got to look at both side of things. And
Gotcha.
then,
Yeah.
sorry, go ahead.
Yeah, just one kind of question that'll help someone understand. They just ask, can you just explain again what the term gross up means? Why have we grossed up
Yeah.
by 15%?
So yeah, so there is a terminology behind like how dividends work. So, to avoid double taxation, what they do is on the corporate side, even though you've taken out the dividends, you've already, incurred the corporate tax side of things, right? So
Mm-hmm.
when you bring it into the personal side, they have to gross it up, but then to offset it, they give you the dividend tax credit.
Gotcha.
That's just the terminology of like how dividends work. That on the personal side, they gross it and then they offset it with the dividend tax credit, just of the calculation to make sure you're not getting double taxed. You're not getting double tax on the corporate and on the personal side.
Okay. Yeah.
Okay.
Thank you.
There's
That's
there's a
really,
big there's a lot of calculation that goes on, but this is like the bigger picture
yeah.
explanation of how this works.
Yeah.
Okay.
That's awesome.
But again, as I said, even though your dividends are grossed up, you are getting that dividend tax credit to offset that.
Yeah.
Okay. Now, again, like, now we got to look at the whole corporate versus personal, right? I have to pay my corporate taxes. I also have to pay my personal taxes. And do we see much of a difference as we looked at it? We know corporately, when you took a salary, you paid less taxes, 5,000. You paid higher taxes when you took out a dividend, right? Personally, you paid higher personal income tax, but as a dividend, you paid lower personal income tax. So when we look at total taxes, we got to look at corporate and personal. And you will not see much of a difference between, corporate and personal and overall taxes. Now, as I mentioned, if you have childcare expenses, you have RRSP contributions, you have a lot of those deductions. That's when we can, try to do a little bit more tax planning. But this is just people who don't have those kind of expenses or deductions, right? So just to kind of like, give you an overall, it's like this is part of the integration process of how, the Canadian tax system works, because they want to make sure one doesn't give you much advantage over the other.
Yeah, okay. And but it's that nuance where at times we
Yeah.
may need that professional guidance because all our
Yes.
situations are so different,
So
aren't they?
different.
Yeah, there are even questions, because people have maybe some international income. They have a
Exactly.
spouse who, might not be working or might be earning $1 million a year. So I
Exactly.
suppose it's in those where we kind of
Need to.
need the support. And I know perhaps you wouldn't say this, but Vartika, and we're thankful to have you on here. But I suppose the thing is not necessarily go to Vartika, but go and get professional advice, isn't it?
Exactly.
Yeah, it's not a
I break
place to save.
I totally say that, like, yeah, it's not something. That's what my first slide was. It always depends. It depends on your situation. We always look at what your situation is, what makes more sense for you as a business owner. And you're very right. There's no such thing as that I can save taxes. There's only ways for us to defer taxes. So we can look at strategies so we can help you defer taxes, so that you're not just, taking out all the money and paying all that tax in 1 year when you literally didn't need to do that. But you can help yourself, kind of like, help yourself make sure that it's only being deferred for the future periods, and look at your goals as a business owner as well, right? But overall, like, because of the integration system, you're not going to see much of a difference. There's like not much of a difference between taking a, like, I get this all the time. By the way, my friend, pays a dividend and saves taxes. Again, yes, they do save it on that CPP, but again, like, we are having to look at other benefits as well, right? So you have to look at your personal situation, not just look at like, oh yeah, I didn't pay that much taxes in, when I took my dividends out. Again, we looked at both corporate and personal. Like, we have to look at the overall, because you are the business owner. So you need to pay out from the corporation. You also need to pay personal. So based on the integration, like the way the legislation is implemented in the income tax world, you will not necessarily see a whole lot of difference between one over the other. As I've already talked about this, salary is a tax deductible to the corporation, so it results in reducing your corporate taxes. And personal taxes is paid on salary or bonus payments, whereas dividends are not a tax deductible for the corporation. So you ended up paying more taxes in the corporation, but then you get the dividend tax credit to kind of reduce your personal side of things. So we always talk about this. What are some of the considerations you can take? Like, if making payments on a time is your weakness, then you might as well pay yourself dividends, because as I mentioned, if you don't put yourself on a proper payroll account, then you can incur a lot of those interest and penalties. Another consideration you want to make is bank financing. Again, if you're looking for mortgages, or even if you're looking for a loan for your corporation, you may want to pay yourself a bill, like a salary or management bonus, because they like to see that, a T4 slip. If you're planning to go on a maternity, paternity leave, you as a business owner can opt to be on a EI. And then eventually, if you're planning to, like, reduce some time in the future from work or from your business, then you can actually get some EI payments. Again, you have to opt to do that. RRSP and CPP are always a very important retirement considerations to be made. I think RRSPs are a good tool for people to to invest in the future. So always keep that in mind. And from a CPP point of view, I would also think about disability and survivor benefits as well. Working income tax benefit, again, you can probably get this on your personal tax if you take a small salary. You always do that. Like, so for example, if one spouse makes all the money and the other spouse doesn't need to take out money from the corporation, we always give them a small salary. So they qualify for something called as working income tax benefit. Something to keep in mind. And as we discussed about the mix of dividend versus salary, we can do that. So some of the times we do a mix where we say we'll give you enough salary so you can you can maximize on your RRSPs and your CPP. And then the rest of it, we start taking it out as dividend. You can absolutely do that. It's a very flexible option that we can do. Or we can decide on how much you want to contribute into the CPP, and then the rest can be taken out as dividend. So we absolutely do these plans, and we definitely will require you to sit down with an advisor, look at your goals, and then make sure that makes sense on both ends. So just to conclude, form of the compensation you receive will always depend on many facts and circumstances, as well as your corporation's financial position. So just be mindful of that as well, that the corporation should also have enough money to, let's say, put into payroll remittances, also should have enough money to pay into the taxes, and also should be able to, be able to incur these ongoing costs rather than you just saying, oh, I want to be on a salary. So just be mindful that the corporation's financial positions is also being taken into the consideration while making these, making these decisions. Also look at your, as you've talked about it, like look at your household and your common law spouse's income as well. You have to look at that as well. You cannot just only look at things on your side. You should look at like what's the other income. Again, you also want to look if you have children in the whole picture as well, because your family income also determines your child tax benefits and all that benefits too. So something to keep in mind. And in most cases, as I said, we always do a combination of dividends and salaries to take the tax advantage. And that concludes my presentation. So from here on, I will leave the floor open for questions.
Perfect. Thank you so much, Vartika. There are definitely questions. People have them. Marguerite asks, well, first of all, she asks, can we split it out for New Brunswick? Well, Business Link is Alberta based, but I'm sure there's information online for New
Yeah.
Brunswick as well. Yeah. But she asked the follow-up question. She's planning to incorporate soon, and she's wondering if it's a good idea to register for a payroll account now or wait until she has incorporation.
I always say wait to see your corporation's financial position, right? Yes, you are doing that. Does the corporation has significant cash flow in the corporation to be able to make that monthly regular payments to yourself and to remit that government those remittances as well? Again, look at the other factors as well. Like, do you have children in the whole picture? Are you going to incur those childcare expenses? Do you want to contribute into RRSPs, like build that RRSP room? So look at the whole picture. Like, just because you're incorporated doesn't mean that, you should also have a payroll account. For some, it makes sense. Maybe for some, it makes sense to just hold on, wait until the corporation makes enough money.
Yeah. And I would say something that we see pretty commonly at Business Link is kind of people moving ahead a little quickly on one thing without
Yeah.
taking that stock of that whole picture, getting the professional advice, taking the time
Yes.
to make the right decisions. Just regarding WTIB, can you define a small salary?
Yeah, you can take as much, whatever small salary you want to take. So I have done something even like as small as maybe 3,000, 4,000 from the corporation, or anything lower than the tax credits, like, anything maybe like 10,000 from the tax credit. Again, we have to plug in the numbers into the system, look at your spouse's income as well. So we have to do a little bit of an analysis there. But anything below that federal tax credit, I guess, is considered a small salary from the corporation.
Gotcha. Um, and someone asked the question about if shares are split, so the company's not owned by one person, how does that impact dividends paid?
So that's a good question. So usually we advise if you have multiple shareholders, they should have separate classes of shares. So one shareholder owns class A, the other one owns class B. So you can have more flexibility of how much dividends you can give out to each shareholders. But if they're both same classes of shares and they're both 50-50, if you took out 100,000 from the corporation as a dividend, they both have to declare 50,000 each if they're the same classes of shares. So always go back to the minute book and double check. And if your minute book says the same classes of shares, I recommend changing that.
Yeah, and I suppose, I mean, it always comes back, doesn't it, to
Yeah,
getting the professional advice at the right time. And we've had the
exactly.
question even on here of like, things are tight for me right now. I'm starting my corporation, but you are potentially just pushing some costs down the line by setting it up wrong in the first place. Like we have phone calls at Business Link often, it's someone standing there in the registry and they're looking at, oh, how should I set up the shares of my company? And they've received
Mhm.
no professional advice up to that point. So there's complexities in that decision that we're really, like I say, but the cost will be there, but it
Yeah.
could be in 3 months' time when it has to be done differently. Yeah.
Yeah,
Um,
you might as well do it right from the get-go than incurring some additional cost and surprises later on.
yeah, yeah. And yeah, there's lots that could be said there. Do you have recommendations for a company that incorporated pre-revenue? Uh,
Recommendations. I would say you might as you now that you're incorporated, you're an incorporated business, right?
yeah,
So I guess I said, as I said, we can always just talk more from a tax point of view. Some companies do need to be incorporated. I even know, like, like there's some companies that if they want to apply for grants or they want to apply for permits and stuff like that, they have to be an incorporated business rather than being a sole proprietor. So just be mindful of those things. But now that the fact that you are incorporated, then, just go ahead and just, run this as an incorporated business. Try to bring business into the corporation. The other thing I would recommend is if you know your business income are going to go over 30,000, go and register for a GST account right away, right? Don't wait till the threshold because then your clients are not used to seeing that additional 5%. So you might as well charge them 5% from the start
yeah.
and get
Was
an advisor on board for sure.
Yeah. A couple of final questions here. We're right at
Sure.
11:55. I the oh, I lost the question. Sorry about that. Okay, here's one. Can you explain the one-time management bonus? Would a bonus be done through payroll or is it a dividend?
Yes. No, that's a good question. So we usually do this as a year-end planning. So let's say the individual never took a salary throughout the year, or like, they ended up taking money at the end of the year. Then we want to make sure they contribute into CPP, build that RRSP rooms. So we can declare this as a one-time management bonus and make the remittance as that one-time management bonus to the government. It applies the same way where we calculate the CPP portion for like the employer portion, employee portion, and the taxes on it. And then it's also one of the ways to do some tax planning where you can actually declare a bonus as an expense in the corporation and have 90 days to pay it out to yourself. So that's also one way of doing some kind of tax planning, or like to help you reduce that taxable income in the corporation.
Okay. Yeah, perfect. Thanks, Vartika. And I'm going to
Great.
reserve the right to ask the last question myself. So we've gone through this, and it's complex.
Mhm.
And yes, I'm sure some people will get in touch with you, Varnika, but if they don't and they're thinking, I need some
Sure.
professional advice, what should they do? What should go into that decision?
Professional advice, come to these events. Always sign up for these expert advice events. I'm guessing, there's a lot. I actually speak with Alberta Women Entrepreneurs. I speak with you guys. I speak at ATB Entrepreneur Center. So, I would say when you're starting off, like, grab onto these expert advice. Go and like look at for the right information. But when you get to a certain point, do get an advisor on board as you move along. Don't wait until you make the revenues or when things starts to get busy because it gets too late to do any kind of tax planning at the time. It gets too late, right? So always get an advisor on board from the sound of it and from like from the start of it so that you are able to grow your business and get the right advice. And then you know what to do for the future and how to save for the future and how you can actually defer your taxes for the future. That's always how I would advise my clients. Yeah.
But what are some signs of like I know no one and I know nothing. Let's go from that position. Like
Yeah.
how do I know I'm getting someone who knows what they're, a true professional? Like what would be the indicators?
So yeah, so here's one thing, there's always CPA authorized firms versus non-CPA authorized firms, right? So when you are going out to get any kind of tax advice, it's always advisable to go to a CPA licensed firm. That's one way to make sure that they are credible because we are regulated by our body, the good thing or the bad thing, but we are regulated by our bodies. We have to go through a lot of professional development to keep up with our knowledge and, our tax knowledge and things like that. So always, yeah, but again, be mindful. We are not cheap either. We are not like, the most cheapest people here too. So I would say that, you know, look for that credibility when you're looking out. Talk to, like, I think talk to your bankers. They always have good connections with the right accountants too. Yes. I have actually recommended people to go to Business Link as well, like because I guess you guys have a lot of blog posts and you bring, these kind of webinars and seminars too, which are free for people to attend. So these are good starting point, I would say. But reach out and collaborate. Reach out is very important. The outreach is very important.
Actually, and I will just say one final thing. I notice quite often people are scared to do that reach out. Like people
Yeah,
have to know that when they call an accountancy firm for the first time, they're going to have a conversation. The bill is not going to start ticking from the moment the phone's answered. Hey, like you can
exactly.
talk to people. Yeah,
I always have a 30-minute discovery call. Like if you go onto my website, I always do like a 30-minute discovery call and just kind of understand what they're, looking for and where they're at the business and things like that. And then I always then, if they're very much at the start, I'll say like, hey, here's my blog post, go kind of read that and get yourself accustomed a little bit. And maybe when you're at the point, when things are getting bigger and you want more tax advice, then you can reach out in maybe a couple months or a few months, and then we can talk more on the consultation basis.
that's awesome. Well, thank you so much. And it's just been great to hear from you today. Yeah, so we're right at 12 o'clock. I'd like to thank everyone, obviously, particularly Vartika, for sharing such
Thank
knowledge
you.
today. It's been wonderful. We've had pretty much 200 people here the whole time. So
Wow.
that's just so great to see. And the engagement and the questions has been excellent. I know I've not got to every question that's been asked, but I've tried to pick those that perhaps apply to most people. So Vodka is hosting again for us actually in the near future as well. So businesslink.ca/events is the place to get signed up for that. And we'd really appreciate you doing that. But apart from that, watch out for your email because you're going to receive a recording of this and hopefully we'll put in the results of that poll we asked at the start of the event. Thanks, Vodka.
Thank you, everyone, for taking this morning again with me. I hope you found it very useful, and I'm always happy to take any feedbacks you may have too. And you
Perfect.
enjoy
Yeah.
the rest of your day.
Awesome. Thanks, Vodka.